All right, hello everyone. In this particular recording, we're going to go through the homework for Chapter 4. And in Chapter 4 is really a continuation of learning about the budget accounting as well as accounting for encumbrances. But in addition, in this chapter, we learned basic transactions, revenue transactions, and the like for general funds. So we're starting to talk about the various governmental funds, and this is the first of many chapters dealing with the various funds. So the first homework problem we're going to go through is we have a city, the city of Hickory Hills, and they've issued a bunch of purchase orders to various vendors for a total of $1,065,000. And so when those purchase orders are issued, we are going to record an encumbrance journal entry, just like we did in Chapter 3. Debit encumbrances, credit encumbrances outstanding for the $1,065,000. Remember what this journal entry does. It reduces the amount of the available budget balance. And that's basically what we want the encumbrance to do. We want to tell the rest of the city, in this case, hands off this money. This is not available for spending. We have a purchase order in place. We may not have spent it yet, but we're going to spend it really soon. And really soon is the next part. So out of the $1,065,000, they were all fulfilled. So all goods ordered during the year were fulfilled for a total price of just a little bit more, $1,066,900. So when the goods come in, it's a two-step process. If you take a look at journal entry B1 and B2, you can see journal entry B1 is a reversal of the encumbrance. All right, so we're going to debit the encumbrance outstanding and credit the encumbrance. All right, so that means the encumbrance balance is now zero. And immediately after we reverse the encumbrance, we replace it with the actual expenditure. And that's journal entry B2. Journal entry states debit expenditures and credit the vouchers payable, also known as accounts payable. Don't get confused with the fancy wording. And then, of course, paying the payable. Debit the payable, credit cash. So this is a very simple journal entry. I just wanted to show you the two-step process. First, you record the encumbrance, and then as the purchase order is fulfilled, you reverse the encumbrance and you replace it with an expenditure. All right, so that is the main thing that I wanted to get at with this homework problem. Now let's take a look at the next one. We have a city of Troy. They collect property taxes late in its fiscal year. And because they collect taxes late in the fiscal year, it's got to finance part of the operating budget using tax anticipation notes. So we have a situation here where on April 1st, the city estimates it will require $2.5 million to finance all their activities for the government for the remainder of the year. So on that date that they estimated, okay, I need $2.5 million to get through the rest of the year, they had $770,000 in cash on hand. They also had $830,000 worth of liabilities. And lastly, they estimated that they should be able to collect $1.1 million in taxes, current taxes, delinquent taxes, interest, penalties, and the like. $1.1 million. So first we need to figure out how much of a loan should we ask the bank for. So let's take a look at this calculation, if you will. There's no accounting here. This is really just logical. So we estimate $2.5 million more of expenditures to get us to the end of the year, plus our current liabilities of $830,000. The two combined, this means, you know what, we need $3,330,000. And now the question is, where are we going to get the $3,330,000? Well, we already have $770,000 in the bank, and we should be able to collect another $1.1 million throughout the year. We can get our hands on $1,870,000, but if I need $3,330,000, the difference is $1,460,000. That is the amount that we should actually ask the bank for a loan. And of course, if you want additional monies to make sure there's, just in case there's some sort of contingency money there, of course you can ask for more. All right, so the $1,460,000. And let's say we go to the bank and they go ahead and they issue us that note. If it is a short-term note, you will see the journal entry is the same. In the general fund using modified accrual and the government-wide using accrual. Debit cash, credit, tax anticipation note payable. Before I flip to the next requirement, let me just make a note here to let you know. Let's play devil's advocate. Let's say this note payable was a long-term note, meaning it was a 3-year note or a 4-year or 5-year note. So what we would do, the general fund, because of modified accrual accounting, instead of crediting the note payable, remember, modified accrual, you cannot record long-term liabilities. So in its place, it would have been other financing sources. Other financing sources works like other revenue. It's recorded on the operating statement and it increases fund balance. But that's not the case here because it is a short-term note. And the last requirement, we're paying back the note plus interest. So you can see the same journal entry pretty much in the general fund and the government-wide statements. The only difference is in the government-wide statements, we use the term expenses instead of expenditures. And you can see we're paying back the note plus 6% interest for half a year. It was a 6-month note. Very simple. Just wanted to show you something like this because this is real life. This is reality. A lot of governments will run into this timing issue where, yes, they need to pay for budgeted items, but the tax money comes in at a certain time of the year that may not necessarily correspond with the timing of when we need the cash flow. All right, let's take a look at the next problem. At the end of the year, the City of Columbus General Fund pre-adjusted trial balance, and here are a bunch of commingled information. We can see we've got actual operating accounts, we have revenues, expenditures, other financing uses, and we have a lot of budgetary accounts as well, appropriations, estimated other financing uses, estimated revenues, etc., etc. So the City of Columbus uses the purchases method of accounting for its inventory of supplies in the general fund. The city also uses a periodic inventory system in which the amount of inventory used during the year and the amount on hand at end of year are determined by a physical inventory. During the year, $220,000 of supplies were purchased. And by the way, because the government uses the purchases method, when they purchase the inventory, they immediately record an expenditure. These purchases are included in the final expenditures balance shown above. The physical inventory reveals a supplies balance of $152,000 at the end of the year. That represents an increase of $12,000 from the prior year. So what we need to do using the purchases method after the physical count, we need to update our non-spendable fund balance. In this case, our non-spendable fund balance at the beginning of the year, if you see my highlight, it was $140,000. Well, that needs to be increased to $152,000. I will do that by crediting fund balance. And the debit will go to the asset account, inventory of supplies. That is to update the non-spendable fund balance. And of course, our assets for the supplies we have on hand. And the next part of this very simple homework example is to go through the closing entries. Now what I want to show you is we have to close both the budgetary accounts as well as the operating accounts on the operating statement. So if you think back to the first journal entry of the year when we recorded the budget, we debited estimated revenues. So to close it, we will credit it. I'm circling it here. And in the beginning of the year, we credited appropriations and estimated other uses. And so to close them, we will debit them. Balance going to go to budgetary fund balance. And the second closing entry, as you've learned in many accounting classes before you got here, we will close our revenues with debits since they're credited during the year. We will close our expenditures with credits because they're debited during the year. Same thing with other financing uses. And everything will get closed out to unassigned fund balance. And then from that point on, we would update, of course, our other categories of fund balance if we needed to. Pretty simple homework example. Just wanted to show you typical journal entries at the end of the year when we update our fund balance accounts, we close out our budgetary accounts, and we close out our operating accounts as well. All right, next homework problem. We're a city of Waterville. We applied for a grant from the state government to build a pedestrian bridge over the river inside the city's park. On May 1st, the city was notified that it had been awarded a grant of up to $200,000 for the project. The state will provide reimbursement for allowable expenditures. On May 5th, the Special Revenue Fund entered into a short-term loan with the general fund for $200,000 so it could start bridge construction. During the year, the Special Revenue Fund expended $165,000 for allowable bridge construction costs, for which it submitted documentation to the state. Reimbursement was received from the state on December 13th. So journal entries. First, May 1st, the notification of the grant approval. Well, we actually just received grant approval. We didn't earn any monies at this date. We really just received a letter in the mail saying, hey guys, guess what? If you spend this money up to $200,000, we will reimburse you. There's no journal entry required at this point. We don't have a definitive revenue. We haven't done anything yet. So no journal entries required. May 5th, we got a loan. We're the Special Revenue Fund. We got a loan from the general fund. So we're going to debit cash. And this is how the Special Revenue Fund actually does the project. We didn't have any money before then. And we will credit the loan payable to the general fund. Journal entry 3, some expenditures take place. So we'll debit the expenditures, credit the payable. And now that we've spent the money on its rightful expenditures, we can now say we've earned that money from the state. So the follow-up journal entry, you can see we're going to debit a receivable called due from state government, and we're going to credit the revenue. And then ultimately we collect those monies. So we're effectively collecting the receivable, debit cash, credit due from state government. And at the end of the year, we will close our revenue with a debit and our expenditures with a credit. As you can see, the revenues and expenditures are exactly the same amount. And this is pretty typical when we have a grant. There's no such thing as making profit on a grant. Typically, the grant money is to be spent on the qualifying expenditures. And if not spent, monies will have to go back if we received money from the state in excess of what we spent for the project. So this is typical, a local government receiving a grant from a more senior government, in this case being the state. All right, we have various transactions here. None of these really have anything to do with one another. So this is something we're just practicing, kind of like a buffet, if you will, of various journal entries you would see in a general fund or a special revenue fund, since that's really what we're working on here in this particular chapter. All right, number 1, the fire department. A governmental activity accounted for within the general fund purchased $100,000 of water from the water utility fund, which is an enterprise fund. So this is the enterprise fund selling water to the general fund. And we're just concentrating on the general fund side. So we're going to take a look at the general fund. Debit expenditures, credit cash. At the same time the general fund is recording that, you can see in the government-wide statements. Just want to show you side by side. Similar journal entry, except we use the word expenses instead of expenditures. And then, of course, on the enterprise fund side, they're recording revenue. Debit cash, credit the revenue. Number 2, a special revenue fund was awarded a $250,000 reimbursement grant. The general fund advanced $50,000 to the special revenue fund for a short-term period to cover initial costs. So this is a loan. It is a loan going from the general fund to the special revenue fund. So the general fund is going to debit loan receivable, credit cash. The special revenue fund, on the other hand, is recording the opposite journal entry. Debit cash, credit loan payable. And because, take a look at this, I want to show you. Because the general fund and the special revenue fund are both governmental funds, these two journal entries net each other out to zero. They're the opposite. So in the governmental activities column on the government-wide statements, no journal entry is true required. Number 3, the general fund transferred its annual contribution of $100,000 to the debt service fund for interest and principal on the GO bonds, the general obligation bonds, during the year. Okay, so this is not a loan. We didn't use the word loan here. The word that's being used is transfer. A transfer is different than a loan. Transfer is a one-way street. There's no expectation of payback. And so when transfers are recorded, the general fund is doing the transferring out. So they're going to debit this account called Other Financing Uses and credit cash. Other financing uses work like expenditures. They have debit balances and they reduce fund balance. They're both recorded in the operating statement. Now the debt service fund is on the receiving end of that transfer, so they will debit cash and they will credit other financing sources. Other financing sources work like revenues. They have a credit balance and they will always be recorded as a credit. Okay, number 4, the $5,000 balance in the capital projects fund at the completion of construction of a new town hall was transferred to the general fund. This is quite common where the capital projects fund, which we'll study in a couple of chapters from now, the money left over after the project is completed, there is no more need for any cash. We paid all the bills, everything's done. And so typically that capital projects fund will transfer money to another fund, most likely debt service fund, because they're going to need some help paying back the long-term principal and interest, or in this case the general fund. That's pretty common too. So we can see the general fund is on the receiving end of the transfer, debit cash, credit other financing sources, the capital projects fund doing the transferring out, debit other financing uses, credit cash, and the general fund and the capital projects fund, they're both governmental funds, so they net each other out to zero. That is why we see no journal entry in the government-wide statements. And last but certainly not least, the number 5, the general fund makes a long-term loan in the amount of $50,000 to an internal service fund. So this is a loan. We're going to see in the general fund, debit loan receivable, credit cash. The internal service fund, debit cash, credit loans payable. And because the general fund is a governmental fund and the internal service fund, it's a proprietary fund. However, it's recorded with the governmental funds in the governmental activities column on the government-wide statements. So there's no journal entry. These two journal entries effectively wash each other out, net to zero. So this is a pretty decent exercise showing you the fact that there are various interfund transactions. Sometimes it's a transfer, sometimes it's a loan, and sometimes it's actually a fee that's being earned from one fund, and it's an expenditure incurred on the other fund. So very good problem. And last but not least, we have a whole bunch of journal entries here that we want to record, and then we're going to follow up with the closing entries and the financial statements. So let's take a look at this. We're going to follow them one by one. Number 1, the budget for fiscal year 2020. Estimated revenues $3,140,000. They will be debited, and the appropriations $3.1 million. That'll be credited. The difference between the two goes to budgetary fund balance, whatever is needed, debit or credit. The budgetary entry is only on the fund itself. You will not find a corresponding budget entry on the government-wide statements. That's why it says no journal entry required. Number 2, the City Council authorized temporary borrowing of $500,000 in the form of a 120-day tax anticipation note. The loan was obtained from a local bank at a 6% discount. So we're going to debit expenditures for the discount. So general fund, $490,000 is going to be debited. $10,000 is 6% interest on that $500,000 for a 120-day or 4-month period. And so that'll be the expenditures, and the note payable is a full $500,000. Similar journal entry on the government-wide. We just use the term expenses instead of expenditures. Number 3, the property tax levy for fiscal 2020 was recorded. The valuation of the property is $43 million. The tax rate is $5 for every $100 of taxable value. Another way to state this is a 5% tax rate. So 5% of $43 million is $2,150,000. That's going to be recorded as the tax receivable. Now, what the government does, which is different than what for-profit companies do, is they use what is known as the net revenue approach. So the 3%, basically what we do is with the net revenue approach, we're only going to record the revenue for the net amount we believe we're going to collect. Effectively, it does the analysis for doubtful accounts up front. All right, so 3% of the $2,150,000 equals $64,500. That's going to be credited to the contra receivable, the allowance for uncollectible current taxes, also known as the allowance for doubtful accounts, as you may have learned in your previous accounting classes. And we'll show the revenue as the net amount. The government does not use a bad debt expense account. Instead, we just net the revenue. This is called the net revenue approach, and you can see it's followed both at the fund level, the governmental fund level, as well as the government-wide level. So it doesn't matter, modified accrual or accrual. This net revenue approach is used. Number 4, purchase orders and contracts were issued to vendors. This is when we're going to encumber those funds. Once again, the encumbrance is like a placeholder for that budget money. That money is as good as spent. The journal entry, debit encumbrances, credit encumbrances outstanding. The encumbrance entry, just like the budget entry, is only recorded on the fund. It is not recorded in the government-wide statements. All right, now we're collecting some taxes. We're receiving $1,961,000 of current taxes, so we'll credit the current receivable. We're collecting $103,270 of delinquent taxes and $3,570 of interest and penalties receivable. Debit cash for the full amount collected. Now, the taxes receivable delinquent and the interest and penalties, they were recorded as a deferred because they were actually assessed in prior years. So in the prior year, I had a liability on the books called deferred inflows. Well, it's like a liability called deferred inflows. So now that money can be recorded as revenue. So I'll get rid of the deferred inflows with a debit, and I'll credit revenues. All right, while that's going on in the fund, in the government-wide statements using accrual accounting, the first journal entry is the same, but there's no journal entry to record amounts that were in deferred into the revenue account. That's because in the government-wide statements, which uses accrual accounting, that $106,000 was recorded as revenue in a prior period. Remember, for accrual accounting, you just need to assess the taxes, and at the moment you assess it, it becomes revenue. But with the modified accrual, the revenue recognition is a little bit more complicated. You not only need to assess the taxes, you need to collect it within that year or a 60-day period after year end. So effectively a 14-month window. If it's not collected in that 14-month window, we have to record it as a deferred inflow. And it will be recorded as revenue whenever we collect it, which is the case here. We're collecting it late. Number 6, additional interest and penalties $3,430. 30% is deemed uncollectible, so 30% into the contra receivable, and 70% of the 2,401 will be recorded as the net revenue. Same journal entry for the government-wide. Just with the government-wide, remember, I need to point out the revenues. If you recall from the prior study, the prior chapter, revenues at the government-wide level are either program revenues or general revenues. Well, anything associated with taxes are general revenues. Number 7, because of its change in state law, the city was notified it will receive $80,000 less in intergovernmental revenues. So what we're going to do, because we have this change, we are going to amend the budget. So that's what journal entry 7 is. It's amending the budget. So we're going to reduce the estimated revenues. Remember, estimated revenues had a debit balance. So we'll reduce it with a credit. And then, of course, the opposite side of the journal entry is this budgetary fund balance. And because budgetary accounting was only at the fund level, you can see the government-wide, no journal entry required. Number 8, delinquent taxes were deemed uncollectible and written off. The associated interest and penalties were also written off. So we'll write it off just like you learned in prior accounting classes. You'll debit your contra receivables, your allowance for doubtful accounts, and you'll credit the receivables directly. Same journal entry on the fund as well as the government-wide. Okay, number 9. Total payroll during the year was $819,000. So we'll debit the expenditures for the payroll expenditure. Of that amount, $62,000 was withheld for the employees FICA, $103,000 for employees federal. The sum of those two numbers is $166,400. That's due to the federal government. $34,000 for state taxes. Credit the liability due to state government. And the remainder is paid to the employees in cash, credit cash. While that is recorded on the general fund, the government-wide using accrual accounting, very similar journal entry. We're just going to call them expenses instead of expenditures. Number 10, the employees' share of their FICA was $62,690. Debit the payroll expenditure, credit due to federal government. Very similar on the government-wide, except we use the term expenses. Number 11, revenues from sources other than taxes were collected, $947,000. Debit cash, credit revenues. At the government-wide, similar journal entry, just have to remember revenues are either general or program. I don't have any other information to tell me that it's a program revenue, so I'll default to general revenues. Number 12, amounts due to the federal government for FICA and state and federal withholdings were paid. So effectively all we're doing here is paying the payable. We'll debit the liabilities and credit accounts payable or vouchers payable. Number 13, purchase orders and contracts encumbered in the amount of $1,988,040 were filled at a slightly less cost. So in this case, in the governmental fund, it's a two-step process. First, we reverse the encumbrance at the original encumbrance amount, debit encumbrance outstanding, credit encumbrance, and we will replace it immediately with the actual expenditure. Debit expenditure, credit the accounts payable. However, on the government-wide statements, we just need to worry about recording the expense. Remember, there's no encumbrance accounting at the government-wide level. Number 14, vouchers payable were paid after deducting a credit for a purchase discount. So in the general fund, we'll debit the payable, credit cash for a little bit less, the $8,030. We will reduce the expenditure for the discount. Very similar at the government-wide level. Number 15, that tax anticipation note, which was short-term, is paid. So we'll debit the liability and credit cash. Same journal entry at the fund level as well as the government-wide. Number 16, and this is unique to the governments. What the government does is they actually have different accounts in their trial balance for delinquent taxes as well as current taxes. And what we're saying is, in this case, There's a $189,000 balance in the current taxes receivable is now delinquent. So we will debit the delinquent receivable and credit the current receivable to get rid of it. In addition, we will debit the allowance from collectible current taxes to get rid of it, and we will credit the allowance from collectible delinquent taxes to establish the delinquent receivable, contra receivable, excuse me. In addition, because there are revenues that were charged, that were recorded in the current year that have not yet been collected, that amounts to, and you can go back to the journal entries, all of the revenues that we recorded that we did not yet collect, we now need to show, we needed to show it coming out of the revenue account with a debit, and in its place recorded as a deferred inflow. Remember, once again, we have to not only earn the revenue, but we also need to collect it within that year or the short 2-month period after year end. If not, we have to record this journal entry. The government-wide, the first 2 journal entries are the same. We're going to establish the delinquent receivable and establish the allowance for uncollectible delinquent taxes. But taking money out of the revenue and putting it into the deferred inflow account does not have to be done at the government-wide level. Remember, the government-wide level, we're going to use accrual accounting. And accrual accounting dictates we can record the revenue as it's assessed. And last but not least, number 17, we basically see that the inventory of supplies has increased to $3,000 from the beginning of the year to the end of the year. And that $3,000 increase, we will debit the asset, inventory of supplies, and we will increase our non-spendable fund balance. Because this is a journal entry using the purchases method, which is allowable for the modified accrual governmental fund, but with the government-wide, we have to use the consumption method. We don't have to worry about journal entries to update our inventory of supplies. We're going to record the asset as we purchase it. All right, so that was part A. Part B is closing entries. So at the end of the year, we'll close our appropriations. They were opened with a credit, so we'll close it with a debit. Estimated revenues were opened with a debit, we'll close it with a credit. And then we'll close our operating accounts. We'll close the revenues with a debit, close the expenditures with a credit, difference going to unassigned fund balance. And now the financial statements. I'm not gonna go through all of this. I just wanted to show you. All right, so we have our assets, we have our cash, receivables, delinquent receivables less its allowance, interest and penalties less its allowance, inventory of supplies gives us total assets. Liabilities, we have vouchers payable. We also have deferred inflows. And then the fund balance, we only have 2 categories. We have unassigned and non-spendable. And here is the operating statement. We have our revenues, we have taxes, interest and penalties, and other sources. Gives you total revenues. Expenditures, salaries and wages. Interest, other, gives you total expenditures. Subtract it from total revenues. You get excess of revenues over expenditures. Also, we have a $3,000 increase in the supplies. If you take these 2 numbers, add it to the beginning fund balance, we will get ending fund balance at the end of the year.